Good morning. This is Bakes, Kevin Baker with Bakes Takes. Welcome to the podcast. It's Saturday, May 15th. Hope you had a great week. And let's get right into it, folks. Why I do this. My sons, Bobby, Jack, they're in their 20s. And frankly, this is a great excuse for me to stay connected to them on a almost daily basis. And it just works. I was a broker in the 87 crash, got my head handed to me, and realized that I needed to learn a lot. And so I did. I went back and earned my MBA. I read everything. I read hundreds of books, everything from Livermore to Lynch. Really studied technical analysis, reading charts. And I go technical analysis first, fundamental second. It's not right or wrong. It just works for me. I read voraciously the Journal, Barron's, the Economist. I listen to dozens of podcasts. I devour relevant newsletters. And I monitor what my Google alerts on all these crazy themes I come up with, what Google alerts kicks out. And I point you to them. I always give attribution. If you want to read all that stuff, great. They're always in the show notes. But if you don't want to do that, know that I'm doing it for you. And hopefully in this half-hour week, delivering you money-making ideas on a regular basis. And tell me if I'm not, but that's the intent. I eat home cooking. I have no conflicts. All I do is talk about what I'm invested in, what I'm interested in. And so what are your pain points? I really want to be helpful and serve, and I'd like your feedback. Problems you want me to solve or at least address, topics I should cover. Keep them coming, please, and thank you. Ideas for the future. We've been doing this about a week. Mike and I got together in the depths of COVID, and I think we both thought we were crazy, and we started doing this. And we'll always do a free component of what we do, but we have to pay for the show. I got to pay Mike and other things. And so what I'm going to be doing is offering premium levels, Patreon levels. Don't know exactly how that's going to shake out, but for example, a weekly call with me that's an hour, maybe more in depth, where your personal stocks and your personal ETFs, we can go through that, or just, questions about what's going on in the markets. I teach technical analysis. I would love to do that. I really enjoy it. And I'm realizing that I see things that the rest of the world doesn't see. I used to think it was obvious to everybody. I'm realizing that's not the case. And I want you to help me design the show. Could you suggest guests that I should reach out to or shows I should appear on? I really want to do that. I'm always searching, but I miss things, so I'd love to hear what your thoughts are. I realized this week that I sold one of my positions, and I text Mike and I text my sons, and I'm wondering if you'd like that to be broadened out to you so that you see, in real time what I do and not have the lag. So my number is 610-331-4283, and tell me if that's a service that you think would add value. I think it would, but it doesn't matter what I think. It matters what you think. My disclaimer, this is not investment advice. Please conduct and share your own due diligence. The more this becomes a community, the more money we make, the more fun we have, and I really appreciate it. So the first part of the show is fan mail always, and I really enjoy this. I'm constantly getting questions on GameStop. And, I said it this past week, it's do or die for GameStop and this idea of a wedge breakout. Which is obviously what all you hodlers are looking for. But I also put the possibility out that it could break down. And we're frankly at high noon, the deciding point, tipping point, you pick your metaphor. The wedge is just about done, and it's got to happen now. I mean, this week, Monday, Tuesday, they hire the CEO of their dreams. They find the digital strategy of their dreams. And we need a high volume breakout now, period. And there's only 11.1 million shares short. The kerosene has been reduced dramatically. So you don't have the squeeze capability that you used to have that drove this thing to 483 in the first time. So stay tuned. I want to have this break that 212 level and rock and roll. But it's long in the tooth now. So I'm going to tell you when I'm right, and I'm going to tell you when things don't work out too. That's just the way it is. AMC, getting more questions on this, and I tweeted about this and sent some other things out this past week. and go to at Bakes Takes _ for my tweets, because I tend to do it when these things are really happening. Big picture on AMC, the movie theater company. The short interest is really high, 93 million shares. So there's a lot of kerosene around in AMC, and it's just a nice looking chart. We took out this 1222 level that I mentioned. We're doing it on big volume. Please go to the YouTube channel and check out the arrow that I drew here. And above 1454, that's resistance. And when you take that out, you're going higher, I think. So it's a prettier chart. The volume is picking up on the upside, which I know I harp on ceaselessly, but it works. And so AMC is looking interesting to me. And let me know what you think and argue with me if you want to. So my take is GameStop, GME, now would be great. Otherwise, the wedge didn't work. And that just happens. This is a game of probabilities. And, if you can beat Ted Williams and hit 406, you can make a lot of money in this business. AMC, the Wall Street Bets friends that I have asked me about it, and it looks bullish. It really does look bullish. It looks real bullish about 1454. So stay tuned. Next, Charlie from Texas. Charlie, thanks for sending your question in again. And he asked about ETFs. I won't go through the whole question here, but in essence, is there an opportunity of arbitrage, a discrepancy in price, where the price of the ETF is different than the NAV, the underlying portfolio that represents the ETF? And are there ways to make money from those discrepancies? And the short answer is I don't think so. There's an authorized participant that forms creation units. So ETFs grow and shrink with buy and selling flows. And so, for example, an ETF tracking the S&P 500, they'd form a creation unit of all the shares in the S&P in a weighting equal to the underlying index, and then they would transfer the creation unit to the ETF provider on an equal NAV value basis. And so to make a long story short, the authorized participant, Bank America, JP Morgan, somebody like that, is doing what you're suggesting. They're closing the gap, if it exists, and it's probably pretty small usually, between the ETF price and the NAV on an ongoing basis. So I don't think there's much to do here. I think there's other things to do with your time. I like your thought process, but I think that there's someone sitting on a desk in Manhattan right now that wants to keep the NAV and the ETF price roughly equal, and I think they do a pretty good job of it because I haven't seen any wild discrepancies in a long time. So, Charlie, thanks for the question. That's my story, and I'm sticking to it. Bobby, my oldest son, when he was home, we talked about, is the economy extended? Is the stock market extended? What do you think about stimulus and unemployment? And I really thought long and hard about this. My first inclination is I can't buy the economy. You can't buy the economy. We can buy stocks or ETFs that comprise groups of stocks. And so that's the lens and filter that I always go through. I've never been an economist. I've never played one on TV. I don't think that having an economic opinion and then investing with that, it's never made me a lot of money. So I'm very bottoms up, very chart driven, and I like to catch big themes early and then ride them as long as I can. And this came to bear this past couple of weeks, and I just used Apple as an example because it's the number one stock in the S&P. But the Apple revenue and earnings, blew the doors off, and the stock didn't care. And so when that happens, you have to ask yourself, what's it going to take to find an incremental buyer that can drive the stock higher? And that's what we care about. And the answer is, the market has already discounted this good news. And it goes back to the conversations we had in July or August of last year. Why is this disconnect? Why is the stock market screaming in the midst of horrible economic news, horrible COVID news? And the answer is stocks are a discounting mechanism. They sense the future, they price in the future before it gets here. And so to rely on the news to make money in stocks is going to be a very frustrating experience. And I hope that I give you some tools so that we get on things earlier. So, and then the next part is, and Bobby, this dovetails very nicely with your question. Stan Druckenmiller was all over the airwaves this past week. He was on CNBC. He wrote an op-ed piece in the Wall Street Journal, and he said the Fed is playing with fire. And in essence, I won't go through the whole, but I recommend you go to it. I got the link to both the interview in CNBC and the story in the Wall Street Journal here. And what he, in essence, says, and I agree with this fervently, the emergency conditions are behind us. There's no need to have the Fed buying $40 billion of mortgages every month and $80 billion, with a B, of treasuries every single month. The COVID situation is dramatically better with the mass news that we had the other day. And just look at the numbers. It's just, it's over. And so this thought process that we have to keep flooding the money, flooding the market with liquidity and with money to keep everything going, I think is crazy. But so here's my take: the Bank of Americas, the J.P. Morgans, the other APs that are looking for this arbitrage in the ETF world, I think it's too fleeting to exploit. I'd go to other things. Tech is giving us a warning sign, Bobby, about the extended nature of the market, where you have terrific earnings and people yawn. That's a problem. You want to have upside surprises that agree with applause and new highs, and we're not seeing that. So now other groups are showing different action, which we can talk about. The Druckenmiller concerns, by the way, applies to Congress and Biden as well. We don't need this infrastructure bill. We don't need the extent of it. We don't need all the pork and fat and largesse that's in it and all the squandering that Congress is famous for. So, and we're talking numbers with a T, 1-2 trillion. It adds up to be real money. And so we have this overheating economy, rapid inflation, which we'll talk about some more, and then the Fed pouring money onto the system, and then the Congress borrowing money to put into, whatever Biden thinks is an infrastructure bill, and someone should buy him a dictionary and a thesaurus because it's not working. And the other part of this is, and I've fallen into this sometimes, I want you to focus on what's happening rather on what you think should happen. I can get on my soapbox too and argue about the Fed, but Powell doesn't care. He's going to do what he's going to do, and so our job is just to make money with what we're given. So, and same thing with Congress. I don't have a vote, so whatever they do, I'll respond and I'll do accordingly. But the other part of some of these election themes, say, taxes are going up. Well, Biden's going to have a heck of a hard time getting the taxes that he wants. We're already seeing that. He basically has to run the table of the Democrats. And the same thing with the infrastructure bill. That's not going to be $2+ trillion. They're not going to have it. So, the reality is coming to bear. And do me a favor, my whole thought is you got all you folks out there with Robinhood accounts, Fidelity accounts, reading Wall Street Bets, and I'll put my work, research, thoughts, analysis up against anybody's, and we're making money. It just flat out works. I mean, what if it works? It is working. We're seeing that with the portfolio that I shared with you last week. We're in different groups and themes than anybody else out there, as far as I can see. And so send me your stocks and ideas, and I'll offer a strategy for them as well. Please stay tuned, but please share this with your friends. Next segment is my themes and groups. And I sold Hero, the Global X video game and esports. And I tout my self-discipline. I talk about it a lot, and I follow it. And so the first part of the sell discipline is after a big move, and this qualifies as a damn good move. We made 14% since inception. Not great, but it beats a sharp stick in the eye. And when anything closes below the 200-day moving average, I usually say sell a third, but these are small dollar amounts. And so I just, sold all of it. If I had a larger amount of money, I'd use the other two parts of the sell discipline. But Paul Tudor Jones has talked about in the past a legendary hedge fund manager who made a fortune shorting the 1987 crash, said nothing good happens below the 200-day moving average. It's kind of like football coaches saying nothing good happens after midnight. You never hear about shootings at a Bible study. It's always a nightclub at 2 a.m. It's the same kind of thing with the 200-day moving average. So now, there are exceptions to that. But anyway, we sold video games and esports. It's been good to us. I wish them well. And, I'll change my mind if things develop in the future. But for now, here's my take. I like gaming and esports. I think it's a great trend. I think the money has been made for now. I think there might be a little bit more of the moving to reopening plays that is playing in here. The multiples were pretty rich, and so we made our money, and I'll take it. The other themes, and this will kind of go into the inflation argument. We were in these months ago. Bitcoin months ago. Uranium months ago. Inflation beneficiaries. Cannabis to a lesser extent. Copper, we were bullish on that before most people were. Sugar, soybeans, wheat, corn, the softs, agriculture, and shorting bonds. So we've got a portfolio that's pretty well designed for what we're seeing right now. And I just ask you to be honest with yourself. Go look at yours, and is it behaving like ours? And if we add value, please join us and adopt some of our ideas. That's all. My next segment is Gray Swan, and I really don't want to have a weekly entry into this, but I'm not going to be an ostrich either. So last week we talked about China-Taiwan sort of being a back of the Economist kind of story, that if it makes it to the front page of the journal, it's going to be hurting stock prices. This week we have, again in the Economist, which I really enjoy. They've got great reporters all over the world. They have a global view. They're not U.S.-centric. And I learned things, and I hope you do too. Israel and Hamas move closer to war. And, being cynical, I kind of thought they were always at war. But this is accelerating even by Jerusalem and Holy Land standards. May 10th, Palestinian militants in the territory fired more than 1,600 rockets at Israel, which is a very small country, as you know. And Israel, in turn, has carried out hundreds of airstrikes, and it's continuing today. I just got a notice on my phone as I was driving here to the studio. So the UN is meeting. It's intensifying. I mean, this is the most intense round of warfare since 2014. Israeli bombs destroyed 3 tower blocks in Gaza that were housing the offices of Hamas, the militant Islamist group that controls the territory. Hamas and its allies have fired huge barrages of rockets at Tel Aviv and southern Israel. Scores of people, mostly Palestinians, have been killed. So how this impacts stocks and groups, I don't know. Jerusalem has a very vibrant technology community, so that's part of it. Does this spread? Does it impact oil in the Middle East? I don't know yet, but I want you to be looking out for this and have the antenna up. I already have it in my Google alerts, and we'll see how this develops. But I don't want you to walk in on a Monday morning and something crazy happens in these Gray Swan areas that surprise you. So I hope it's helpful. You can tell me down the road. Podcasts of the week. I'm a big fan of On the Tape, Guy Adami, Danny Moses, Dan Nathan, and they talked about the Druckenmiller op-ed too, and really kind of echoed my sentiments that we don't need to be doing all this. And I think politically they've sort of trapped themselves that they have to keep printing money. And I don't know how the unwind is going to go. I doubt it goes well. I draw yourself to well, this is my take. Watch the markets if the bond buying that I mentioned is tapered. Go back to 2018, and this has to be done very gingerly. I mean, the Fed was doing modest 25 basis point increases interest rates and modest tapering of the bond buying, and the market hated it. Went down 20% in about a month right before Christmas. So I'll be watching this. A lot of other people will be watching this, but this is it's a very difficult corner to get ourselves out of now that we've painted ourselves into it, and or the Fed's painted themselves into it. We'll see how it goes. Next, reporters of the week. Inflation surge rattles markets. And this was the news of the week, except for Elon and SNL, which, by the way, is not funny. It is not funny, and he was probably funnier than expected, but I thought SNL stunk. And I also think that the story we talked about last week with the SEC looking at him and how he influences the price of digital currencies, meaning Bitcoin and Doge, that's going to be problematic. The SEC is going to take a look at him. Scott Galloway agrees with me. But I put this chart up here, and I really recommend you go to the YouTube channel because it really puts this in perspective. This is inflation going back to 1960, and you obviously the mountain that occurs in the late 70s with OPEC and the oil shocks and what have you. And it's obviously been pretty benign for the ensuing 40 years. But last week, the market was surprised. I don't really think they should have been. Showed consumer price up 4.2%, the biggest rise since 2008. And you say, why do I care? Well, because if you buy a used car or truck, it's 21% more expensive. Household energy up 6%. Furniture up 3.5%. Airfares are up 9.6%. Gasoline up 49%. So the Fed can say this is transitory, but it's hurting people's wallets. And this is Gwynn Guilford, by the way, who wrote this great piece. But the chart is worth the price of admission. So if it's transitory and we chomp around here at 2 to 4%, okay, don't care. I've also shared that chart in the past where 2% inflation is the sweet spot, and once you go much to the right or to the left, it's bad for stock prices and their valuations. So 4.2 is rate of 2, and stocks didn't like it, and it isn't cataclysmic yet, but stay tuned. And then Barron's, which obviously is owned by the Dow Jones, both Wall Street Journal and Barron's are tied. Barron's is the weekly that I really enjoy. It's the cover story here, and this is great. A great story by Lisa Belfus. Inflation is here and harder than it looks. Why it's time to worry. Not a subtle title. And I started underlining the parts I wanted to bring to the show. I underlined basically the whole damn article. So I had to show some restraint in the interest of time and bring just a couple of the points. But it's worth reading and worth going to the link. Nebraska Furniture Mart Chairman Irv Blumkin was interviewed. They were bought by Berkshire Hathaway, Warren Buffett's company, years ago. And he reports the price of one shipping container over the past 6 months has gone from $3,500 to $10,000. So nearly a triple in 6 months. Short on containers, suppliers are out of storage and halting production, exacerbating Blumkin's order backlogs that are 6 times what they were a few months ago. And broadly, Blumkin says his vendors for just about everything have increased price multiple times over the past 3 months, anywhere ranging from 3 to 8%. So that doesn't sound transitory to me, and we'll check back in the next 3 and 6 months and see what happens. But that's just one example, and there's many others. Other part of this is the inflation figures. we don't have the luxury of ignoring food and energy the way the Fed does in a lot of their pricing metrics. So, but you can't help but notice, and I can't, 17% jump in existing home prices. You probably have an anecdote. I've got a friend had an offer, had to put a house up and multiple offers, and then received a cash offer that was $50,000 over the asking price, and he hit the bid. So this is happening left and right, and that's what happens when you have 3% mortgage rates. I know that was a cash offer, but you get the idea. And I didn't realize this. I never really thought about it. For the average American household, food, energy, and shelter are 50% of income before taxes. And all of those are going north. All of them. So, so my take is it's not the 70's yet, but it's not bullish. And you can say it's not bearish, but it's not bullish. And you can buy and hold if you want to, be a hodler. But again, nothing good happens under the 200-day moving average. And so, if you don't have commodities in your portfolio, listen to us because I think we can be helpful. I'm very grateful that we found uranium, for example. And I hope we can help you down the road. So that's the show, folks. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Follow us on Twitter at BakesTakes_ and other social media. Please use your voice memo app, tape your questions, and email to bakes@bakestakespodcast.com or write in if you'd prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Thank you very much, Mike. Have a great week. This is Bakes. And for much-needed levity, Pablo Francisco does about 100 voices in this one skit. I'm exaggerating, but it's still great. Little Tortilla Boy, too. It is silly, but it's funny, and I think you'll enjoy it. Have a great week, and I'll see you soon. Take care now. Bye-bye.